Hi, everyone. Welcome to Carson's Take 5. It's just me here today, Sonu, and Ryan's out. But we just had the Fed meeting. The Fed cut interest rates for the first time after taking a 9-month pause. And that's essentially what I'm going to be talking about today, why they cut and what to expect next, right? So as we're titling this, the Fed cut, how many more? That's the big question. Look, this was expected. The Fed was expected to cut rates by 0.25 percentage points at the September meeting. That takes their policy rate to that, around 4.1%. And as I said, this comes after a pretty long pause for 9 months, right? And why did they pause? Because they were worried about inflation, right? Inflation's been going the wrong way. Remember, the Fed has two mandates. One is stable inflation and the other is maximum employment. And there's risks to both sides of that. Over the last 4, 5, 6, 7 months, we've seen inflation go the other way, go the wrong way as far as the Fed is concerned. Inflation's edging up to around 3%. But now they're looking past that and they're cutting rates. Why? That's because the labor market data looks pretty shaky. We saw payroll growth really ease over the last couple of months. In fact, in June, the economy lost jobs. The unemployment rate is up to 4.3%. And that was the rationale for the Fed cutting rates in September, starting to cut rates again. But like I said, this was expected. And the big question is, okay, what comes next, right? Right now, it looks like we are going to get at least two or maybe, at least two more rate cuts for this year and maybe one more next year. That's what Fed members project themselves. In their every quarter, they update something called a summary of economic projections. They estimate what GDP growth is going to be, and they bump that up. They write down what they expect inflation to be. They didn't change their estimates for inflation compared to June, and they didn't change their estimates for the unemployment rate as well. They expect the unemployment rate to be about 4.5% by the end of the year. Right now, as I said, it's about 4.3%. But the fact that they're cutting rates tells us that they're really worried and they want to manage the risk of the labor market starting to go south faster than we expect, right? Right now, the labor market may be on the edge of a precipice. It could go, south pretty quickly. And that's what they want to protect against. Meanwhile, they think inflation, it's elevated right now, but that's quote unquote transitory. Powell didn't use that word, but he was very careful about avoiding this word. They used it back in 2022, and obviously things didn't go, as they expected, and inflation really rose to the highest levels in 40 years. So that's why I think they're pretty careful about avoiding the word transitory. But nevertheless, they think inflation, this elevated period of inflation will pass, and that's because the tariff impact on goods should be one-off, right? At least in theory. And, that is a reasonable estimate right now. And so the question is, what happens in 2026? I think that is really what, markets are looking at right now. And while the Fed expects to cut rates just one more time in 2026, which would take the policy rate all the way down from 3 to about 3.5, 3.4%, right? Remember, a year ago, policy rates were about 5.5%. It's come all the way down. It's going to probably go down to 3.5, 3.4% by next year. That's what Fed members estimate. But here's what's interesting. Markets actually expect a lot more cuts, right? And that's partly because they think the Trump administration will be able to get their people onto the committee, and they're going to push through rate cuts like President Trump wants, right? And what do lower rates do? Now, on one side, it doesn't help savers. Savers are going to get less in their savings accounts, money market accounts, things like that. But on the other side, it boosts cyclical activity, whether it's housing, manufacturing. Lower rates help people to access more loans at a cheaper rate, right? So that's going to be a big deal. On top of that, we are going to get some fiscal stimulus as well in 2026, especially because, as seniors are going to get a higher deduction on their Social Security income, there's going to be a deduction for tips, state and local property taxes, things like that. There's going to be a larger deduction available for that. And that's all retroactive to 2025, which means a lot of households are going to see, a larger than normal tax refund in the first and second quarter of 2026. And most of this is likely to be spent. That's going to be good for the economy. Now, there may be a little bit of an inflation problem, but like I said, the Fed's going to look past that. And even the administration is probably going to look past that and say, we care more about growth. But at the end of the day, that's going to be good for the stock market. It's going to be good for profits. So, we are looking at a period potentially of inflationary growth in the first half of 2026, at least given the dynamics of what's happening at the Federal Reserve and even White House policy for that matter. So again, like I said, this is bullish for stocks. The Fed is cutting rates even as inflation remains elevated. And the labor market data, yes, it looks shaky, but at the same time, it's not crashing. We are not seeing evidence that we are in a recession, anything like that right now. And that's positive for equity markets. We're seeing equity markets rally. Today, I'm recording this on September 18th. Equity markets are off to the races, having digested what the Fed just did. So, with that, hope to see you next week. Hope you enjoyed this video. And, good luck with the rest of the week.